For that, Mitesh was talking about mid-cap IT, particularly names like Cyient, KPIT Tech are having a good session. Remember, these are not the typical IT services companies. They're engineering R&D companies. And they've had a big free fall. In fact, you should pull up, Cyient, KPIT Tech, Tata, LXC, how much they've fallen from their 52-week highs, and they're all off 40 to 45%. Now, Ambit has a note, and they say that they like Cyient and KPIT Tech. And this is premised that because the stocks have corrected so much, the current market price or the valuation implies a certain growth rate, right, for the next 10 years. And that growth rate for both Cyient and KPIT Tech is lower than the historical growth rate, which basically means it's possible, perhaps, for the companies to achieve it, right? So now their implied revenue growth rate for the next 10 years, FY24 to FY34, for Cyient is just 2.9% after the correction, which is lower than the 4.6% growth that they've seen in the last couple of years. Similarly, for a KPIT Tech, the current market price or the valuation implies KPIT Tech will grow at 13.5% top line for the next 10 years. Again, lower than the historical growth rate, which gives you greater confidence that the companies will be able to achieve it. But when it comes to other companies, say for instance a Tata LXC or a Tata Tech, these two companies, the ask rate which is implied is higher than the historical growth rates. And for companies like Persistent and Coforge, given the valuations, even after the correction, the valuations imply that these companies will need to grow at 20% top line growth for the next so many years. Is that achievable? Well, remains to be seen. But Ambit has a buy call on Cyient and KPIT Tech because after the current correction, these stocks, the ask rate appears to be far more palatable compared to the others.
Very interesting link there as far as mid-cap IT is concerned. But one stock